When investing in Vietnam, many foreign investors often pay attention mainly to invoices, especially VAT invoice. But here is the question: is having invoice enough to make your costs safe and deductible? The truth is, in Vietnam, invoices are important, but they are not the whole story. Tax authority will not only check the invoices, they will also review the real nature of your transactions and whether you have a complete set of supporting documents. Many FDI investors, when they first arrive, they believe, as long as we collect valid VAT invoices, everything will be fine. Or they think, during the tax audit, officials will only focus on invoices. This belief is common, but it's not correct, and it may cause serious risk for your company. Let me share with you a case study. Your company is in the trading sector. You need transportation for your goods. So you hire a local driver. The driver is just an individual. He cannot issue an invoice. So to help you, he asks another company to issue the invoice for your company on his behalf. But later, this company is discovered by the police as a shell company. They only sell invoices without any real business activities. As a result, the invoice you receive becomes invalid. And now, how can you prove the tax authority that the transportation really happened? If your only evidence is the invoice, that will not be enough. The tax officer may request a service contract with the driver or a transporter, delivery notes and acceptance records, payment vouchers, and other relevant documents. Without this, your expenses may be rejected. So, what happens if you only focus on invoices but ignore other documents? The risks include disallowed expenses, which means higher corporate income tax. You may also have unclear financial statements, creating problems for auditor or headquarters. Damage your reputation when calling for investment or during M&A. Clearly, invoices alone cannot protect your company. So, what should investors do? The answer is build a strong documentation system. Let's look at some examples. When buying goods, you should have sales contract quotation and a purchase order, delivery note, warehouse receipts, bank transfer slip, the valid VAT invoice. For imported goods, you need have custom declaration, proof of import, VAT payment, warehouse, storage, and transportation costs. For goods exports, you need have sales contract, commercial invoice, packing list, customs declaration for exported goods, bank transfer evidence, VAT invoice, warehouse, storage, and transportation expenses. For export services, you need have the service contract with the foreign client, service acceptance minutes, documentation proving the work performed, bank payment documents. For salary expense, you need have the labor contracts and the appointment decisions, timesheets, payroll record, social insurance payments, salary payment voucher, the financial regulation and salary and bonus regulations. For business trip expenses, you need have the business trip assignment decision, clearly stating the assigned employee, purpose, duration, and means of transportation. Invoice like air tickets, taxi invoice, or hotel invoice. Supporting documents during the trip like boarding pass, train and bus tickets. So, these are just a few examples showing that having only invoice is not enough for your company, for your business in Vietnam. In Vietnam, the tax officer look at the real nature of the transaction, not only the paper. This full package of documents is what makes your expenses safe and your financial records reliable. If you are investing in Vietnam and need more advice about these policies, please contact TPM for support. Thank you for watching and see you in the next video.